Should you be an LLC versus an S Corp? Let's talk about it because we've helped clients save thousands of dollars in taxes by switching to an S Corp, but guess what? We've also helped clients save thousands of dollars in taxes remaining as an LLC. And there are many small business owners who are seriously overpaying in taxes simply because they make the wrong entity selection to start off with, or because they never try to optimize their current entity for tax purposes. And to top it off, there's a lot of misinformation on the internet around LLCs versus S Corps, causing many people to be confused and overwhelmed. So if you're trying to make this decision for yourself and set your business up for success, then this video is for you. Because today what I'm gonna do is cover the differences between an LLC versus an S Corp, the paths to saving on taxes with each one, with some math and calculations along the way. So if all that sounds good to you, then all I ever ask is that you hit the like button for the YouTube algorithm. That way other people and small business owners like you can find this video. Stay tuned. Hey there, I'm Sean with LYFE Accounting and Taxes, the accounting company that helps you save on taxes and build more wealth. All right, let's go ahead and dive in with number one and give an overview of LLCs versus S Corps. I want you to know I'm gonna start off with some of the basics and then get more advanced as this video progresses. But at any point, if you wanna skip ahead, then I'll have timestamps for this video down in the description below. Okay, let's compare both, starting with LLCs. You should know LLC stands for Limited Liability Company, and the limited liability basically means that you are not held personally liable for any legal damages of the business. For example, if someone sues your company, then instead of them being able to go after your personal house or your personal car, they can only go after your business assets, which is why LLCs are so popular as opposed to a typical 1099 or sole proprietorship. On the other side of things, S Corp primarily stands for S corporations, or sometimes referred to as small business corporations or subchapter S corporations. It's all the same thing. The first thing I want you to know is that an S Corp is a tax designation granted by the IRS. So you don't register an S corporation like you would an LLC, for example, but rather you would tell the IRS you want to be taxed as an S corporation. Now, there are several similarities between LLCs and S Corps. For starters, they both have limited liability protection of your personal assets. Secondly, they are both pass-through entities, meaning the business itself does not pay any income taxes, and instead the business profits are passed through down to the owners, and the owners pay the applicable taxes at the individual tax level. And keep watching, because I'm going to show some math that shares with you exactly how this can impact your tax outcomes. Another similarity is the ability to form partnerships. So you can have multiple members or partners in an LLC and multiple shareholders in an S corporation. And so when you're looking at your business, you should have confidence knowing that both of these entities cover a lot of ground and have great legal protections. But there are still some key differences as well, so let's cover that some more. And number two, the differences between LLCs versus S Corps. So let's look at some key areas side by side, starting with ownership. LLCs call their owners members, and members can be individuals or entities, and they can have different ownership percentages, and LLCs can have unlimited members, whereas S Corps call their owners shareholders, and they are limited to having no more than 100 shareholders, which can be problematic if you have a business model where you're trying to raise capital from many investors, like a real estate investment fund, for example. Also, when it comes to ownership, S Corps cannot be owned by corporations or LLCs or partnerships and many trusts, but S Corps can own several LLCs. So for example, you can have an S Corp holding company that holds several LLCs, but in general, you cannot have an LLC that owns several S corporations. The one exception is that if the LLC is owned by a single member and meets the requirements to be an S Corp shareholder. All right, another category to look at would be management. LLCs are very flexible, okay? You can choose to have members, which are the owners, actively manage the business, or you can have it run by managers, which is often referred to as manager-managed LLCs, which allows the business to be completely passive. On the other side, S corporations have directors and officers. Okay, so directors oversee the affairs and handle the major decisions of the business, but they do not manage the day-to-day operations. Instead, directors elect officers who manage the daily business affairs, and the shareholders do not manage the business at all. And this is simply how S corporations are managed. There's no flexibility here like there is with LLCs. Now, another big difference between the two are the ongoing requirements. On the LLC side, there are less formalities that you have to deal with. So for the most part, as long as you're abiding by the operating agreement, general compliance for taxes, and renewing your business annually, then you're good to go. Whereas the requirements for S corporations are much more rigid and specific. For example, S Corps are required to hold annual director meetings, issue stock, and keep up with meeting minutes with corporate records. And failing to do so can have your S Corp status revoked. And because of this, there's extra administrative work, so S Corps are often much more expensive to manage when compared to LLCs. Now, of course, the next major difference are tax outcomes and consequences, and I'm going to talk about this a little bit more in great detail in the next chapter, number 3, self-employment taxes. So the big tax that caused many people to overpay when they file their tax return are self-employment taxes. And it tends to hit a lot of new business owners and freelancers unexpectedly because it's something that you don't pay when you are a W-2 employee. Because when you are a W-2 employee, your FICA taxes or your Social Security and Medicare taxes are withheld from your paycheck, which is roughly 7.5% of your income. Now, here's something you probably didn't know. Okay, your employer had to pay roughly 7.5% of your income in FICA taxes as well. So in total, roughly 15.3% of your total income is being paid to the government in employee taxes. Well, as a business owner, you don't have anyone withholding these taxes. And so you'll have to pay the full 15.3%, which is called self-employment taxes. And people who are subject to this tax are anyone who files a Schedule C tax form, such as sole proprietors, 1099s, single member LLCs, and even partnerships. For example, let's say you own and actively run a profitable business that nets $100,000. Well, in that case, you would need to pay 15.3% or $15,300 in self-employment taxes. And that's on top of the federal and state income taxes you must pay as well, based on the tax bracket that you fall into. So this definitely hurts many entrepreneurs. Now, does all of this make sense? If you have any questions, make sure you leave a comment down below. Now, there are two pieces of good news. Okay, number one, there is a limit for which you have to pay self-employment taxes, which for 2023 is $160,200 of your income. So anything above that amount, you no longer have to pay self-employment tax on. The second piece of good news is there are some ways to avoid some, if not all, of the self-employment tax. Let's go ahead and talk about that some more in number 4, the path to saving on taxes. Okay, this section is going to blow your mind. So if you're serious about maximizing your tax outcomes, then make sure you take some notes. And by the way, if you need help with tax planning or tax preparation, then click the first link down in the description below to learn a little bit more about how we can help you. All right, so let's look at 3 scenarios, and let's say in each scenario you have $100,000 in net profit. In scenario number 1, you have an active member managed LLC. Well, regardless of if you have a single member LLC owned by one person or a partnership LLC owned by multiple people, you are likely going to have to pay some self-employment taxes. The only way I can think of that you can avoid this is if you have a business loss or you reduce your taxable income down to 0, which is possible if you're taking a lot of qualified tax deductions or you are aggressively reinvesting into your business. But if that's not an option, then maybe you will enjoy scenario number 2, where you decide to have your LLC elect to be taxed as an S Corp. Because when you elect for S Corp status, then your taxable income is divided into 2 parts, a distribution and a salary, because S Corp shareholders can be both owners and employees, which means you pay yourself a W-2 salary. And when you do this, you only pay self-employment taxes like your Medicare and Social Security taxes on the salary portion instead of all your net profit. For example, if you have net profit of $100,000 and you pay yourself a $50,000 salary and take a $50,000 distribution, well, now you only need to pay 15.3% on the salary portion, which gives you self-employment taxes of $7,650 as opposed to $15,300, because you will pay no self-employment taxes on the $50,000 distribution. And this is why people love S Corp status once they begin making a good enough net profit. But I still need to cover scenario number 3, where you are a passive manager managed LLC. Because guess what? If you own a trade or business activity that you do not materially participate in during the year, then you are not subject to self-employment taxes at all. To simplify, that would mean you're working 10 hours or less per week managing your business, although there are some more minor IRS requirements. And typically this is achievable when you are not working in the business, but rather you are working above the business. And maybe this is something that you build out from the start, like maybe that's something you map out in your business plan, or maybe you buy a business with management already in place. There are several ways to get here, but this is true business ownership and where people can really start taking advantage of the tax code. Also, rental activities such as leasing equipment or leasing properties also don't pay any self-employment taxes. And becoming a passive business owner is really where you can start leveraging tax law like Mark Zuckerberg, Elon Musk, Jeff Bezos, Donald Trump, and many others do, to have a very, very low effective tax rate. So to recap, the first scenario, you would pay $15,300 in self-employment taxes. In the second scenario, you would pay $7,500 in self-employment taxes. And in scenario 3, you will pay $0 in self-employment taxes. Now, what does all of this mean? Let's go ahead and talk about that some more in the 5th chapter of this video, deciding between an LLC and an S Corp. As you probably can tell by now, making this decision has several variables you may want to consider, such as your goals, your business plan, your profits, and much more. For example, someone who plans on aggressively reinvesting back into their business may be fine by simply having an active LLC because they don't plan on having much business profits. On the other hand, someone who is planning on maybe buying a business and having someone else run the day-to-day operations may not need to worry about self-employment taxes at all because they're not subject to them as a passive business owner. Now, I personally look at this as different levels that an entrepreneur will eventually progress to. At level 1, you're just getting started, you registered your LLC, you have no business income yet, and so your goal is to start investing and growing your business. And at that level, you usually just need to remain as an active member LLC and pay what little self-employment taxes that you have to pay. Then at level 2, as you grow and you start seeing maybe $80,000 or $100,000 in net profit, then electing to be taxed as an S corporation is something that you definitely should consider because, as I showed earlier, you may be able to save yourself an extra $5,000 to $7,000 simply by changing your entity structure. But then there's level 3, where as you continue to grow and you start seeing maybe $300,000, $500,000 in profit, then maybe you are in a position to hire a general manager to run the entire company for you and become a passive business owner. And some people who have enough capital can go ahead and jump straight to level 3. But if you're like me, then you have to start at level 1 and build your businesses up to the point where you can reach level 3 and be a real business owner. Now, here's a very, very important note, okay? I don't want you to become an S Corp too early, like when you don't have enough profit. For example, if you only have net profit of $25,000 and you become an S Corp, then you'll have to take about half of that and pay yourself a reasonable salary. And after that, sure, you may save yourself about $1,900 in taxes, but you're also increasing your costs because filing an S Corp tax return is more expensive, and some accountants charge about $2,000 to file it for you. Plus, you're gonna have additional payroll costs. And the real kicker is you may have additional opportunity costs and mental costs from all the additional compliance requirements. All in all, you may end up costing yourself more money and more business growth by electing S Corp status too soon. Okay, now, did you like the video? If so, like the video for the YouTube algorithm and subscribe for more great content. Also, remember, if you need help with tax planning, don't forget to apply with us using the first link down in the description below. Coming up next, I have 2 more videos you may enjoy as well, so check those out if you haven't already, and I'll see you over there.